There is a document available to anyone for free that acts as a direct confession from the most powerful leaders in business. It is not a press release. It is not an interview on financial television. It is a legally mandated report, often over 100 pages long, dense with tables and text that most people consider impenetrable, boring, and utterly useless. This document is the annual report, and to the 99% of investors, it is nothing more than corporate junk mail. But to the 1%, to the masters of capital like Warren Buffett, it is the closest thing on earth to a corporate mind-reading device. Buffett has said he gets more insights from reading these reports than from any other source. He isn't just looking at the numbers. He's conducting a psychological evaluation. He's analyzing the language, the priorities, the omissions, and the promises. He is separating corporate fiction from financial fact. While Wall Street is busy talking to CEOs, Buffett is reading what they write when they think no one is paying careful attention. He believes that within those pages, a CEO confesses their true character, their actual priorities, and their level of candor. This practice, this discipline of deep reading, is the ultimate antidote to the modern world's reliance on soundbites, media narratives, and the hollow pronouncements of so-called experts. It is a masterclass in second-level thinking. It is a low-cost, high-impact intelligence-gathering tool that is available to everyone yet used by almost no one. This is the final promise of true financial analysis, the ability to see a business not as the media portrays it, not as the CEO sells it, but as it truly is. Today we deconstruct Warren Buffett's lifelong obsession with this single document. We will not just learn how to read an annual report, we will learn how to use it to read minds. Our journey begins with the most human element of all, the words. Long before we look at a single number on a balance sheet, we must analyze the language of the leader. This is our first pillar, the language of truth, candor as a leading indicator. To Buffett, the chairman's letter to shareholders, typically found in the first few pages of the annual report, is an audition. It's an audition for the role of a trusted partner. A CEO who writes in clear, simple English, who treats the shareholder as an owner of the business, and most importantly, who openly admits to mistakes, is a CEO who is likely to be a responsible steward of capital. Obfuscation, jargon, and a relentless focus on only the good news are, to Buffett, giant, waving red flags. He's not looking for a salesperson. He's looking for an honest partner. The quality of the prose is a direct reflection of the quality of the thought behind it. And the honesty of that prose is the single best, leading indicator of future performance. To understand how this works in the real world, we have to travel back to November of 1963. The world was in turmoil, reeling from the assassination of a president. The stock market was in a state of shock, and in this environment of fear, a specific panic was brewing around one of America's most trusted companies, American Express. A small salad oil company in New Jersey, run by a swindler named Tino DeAngelis, had perpetrated one of the greatest frauds in modern history. DeAngelis had secured massive loans from a subsidiary of American Express, using his inventory of salad oil as collateral. The only problem was the inventory didn't exist. The tanks were mostly filled with seawater. When the fraud was discovered, the subsidiary was on the hook for losses that today would be valued at over $1 billion. Wall Street panicked. The stock of American Express, a blue-chip institution, was cut in half. The consensus was that the scandal would ruin the company's reputation, that its core traveler's check business would collapse as trust evaporated. This was the moment for soundbites and screaming headlines. Experts declared the company mortally wounded. But Warren Buffett, then a young, relatively unknown money manager in Omaha, did something different. He ignored the noise. He began his own scrupulous investigation, a process of fundamental analysis that went far beyond the hysteria. His first step was on the ground. He went to restaurants, to banks, to travel agencies. He talked to the tellers and the managers. He asked them, "Are you still accepting American Express travelers' checks?" Are your customers still using the card? The answer was a resounding yes. He observed that the brand, the actual utility of the product in the hands of the customer, was untouched by the scandal in a warehouse in New Jersey. He saw that the company's competitive moat was far wider and deeper than Wall Street believed. But this on-the-ground research was only one half of the equation. The other half was a deep dive into the character of the company's leadership, an assessment made possible by reading their public communications, their annual reports. The CEO at the time was a man named Howard L. Clark. Sr. Buffett studied Clark's response to the crisis. Clark didn't hide. He didn't use jargon or blame outside forces. He was direct, candid, and brutally honest with shareholders and the public. He acknowledged the staggering loss, he outlined the steps being taken to deal with it, and he expressed his unwavering confidence in the strength of the core business. He spoke and wrote not as a promoter trying to prop up a stock price, but as a responsible owner facing a serious problem. He projected integrity and competence. Reading the company's past reports would have shown a history of this straightforward communication. This wasn't a new personality adopted for a crisis. It was the institutional character of the firm. For Buffett, this was the crucial signal. The market saw a catastrophic financial loss. Buffett saw a temporary, survivable loss attached to a fantastic business run by honest and able management. He invested 40% of his partnership's capital into American Express stock. It was a massive, career-defining bet. Within 2 years, the stock had tripled. The salad oil scandal became a footnote in the company's history, but the lesson for Buffett was foundational. The language of management, their candor in the face of adversity, was not just a soft factor, it was a quantifiable financial advantage. It was the ultimate leading indicator of a business's resilience and long-term value. This powerful insight into the value of candor is rooted in deep-seated behavioral science. The psychological principle at play is what we can call the transparency trust heuristic. A heuristic is a mental shortcut our brains use to make quick judgments. When an organization or an individual is transparent, especially about their flaws and mistakes, our brains take a shortcut to trust. We instinctively believe that someone who admits a weakness is likely being truthful about their strengths. It signals a high degree of self-awareness and control. It's the Dunning-Kruger effect in reverse. The Dunning-Kruger effect posits that people with low ability at a task tend to overestimate their ability. They are incompetent and unaware of their incompetence. Their language is often filled with bravado and overconfidence. In contrast, truly competent leaders are acutely aware of the complexities and uncertainties of their business. They know what they don't know. Their willingness to admit mistakes isn't a sign of weakness. It's a sign of profound competence. They are not afraid of the truth because they are confident they can handle it. Conversely, leaders who are struggling, who are hiding problems, or who are fundamentally incompetent often resort to what could be called obfuscation bias. They use jargon, complexity, and convoluted language as a form of camouflage. They believe that if they can make the business sound complicated enough, no one will be able to pinpoint their failures. They'll use phrases like synergistically leveraging our core competencies to optimize shareholder value in a dynamic market environment. This is language designed not to clarify but to confuse and intimidate. It's a smokescreen. Buffett's method of reading the CEO's letter is a systematic process for piercing this smokescreen. He is also actively immunizing himself against the, quote, narrative fallacy, a term coined by Nassim Taleb. The narrative fallacy describes how our brains are wired to prefer a good story over raw facts. A charismatic CEO can tell a spellbinding story about the future, about changing the world. This narrative can be so emotionally compelling that investors completely ignore the terrible underlying data. Buffett neutralizes this by focusing not on the emotional appeal of the story, but on its intellectual honesty. Is the storyteller willing to include the chapters about failure? Does the narrator speak in plain language, as one partner to another? By making candor the primary filter, he ensures that he is investing in a business reality, not a business fable. This psychological discipline is what allows him to see value where others see only fear, as in the American Express case, and to see risk where others see only a seductive story. So how do we, as investors or entrepreneurs, translate this powerful principle into a practical tool? We can create what I call the CEO Candor Scorecard. This is a mental model, a blueprint for systematically analyzing the language in an annual report. It's a step-by-step process. First is pronoun analysis. Go through the chairman's letter and simply count the use of we versus I. A leader who consistently uses we is signaling a team-oriented culture. A leader who frequently uses I, especially when discussing successes, might be signaling an ego-driven approach. But the more subtle and important analysis is how these pronouns are used in relation to success and failure. Does the CEO say, "I am proud to announce record profits," but then say, "We faced headwinds from the economy"? Look for the pattern. I for the wins, the economy, or the market, or even a vague we for the losses. An honest leader takes personal responsibility for failures. They say, "I made a mistake in approving this acquisition," not "the acquisition failed to generate the expected synergies." The second step is the mistake meter. Scan the first few pages of the letter with one question in mind. Does the CEO openly and specifically admit to a mistake made in the past year? I don't mean a vague, passive voice statement like, "mistakes were made." I mean a concrete, active voice admission. For example, last year, I told you that we believed our new product line, the X2000, would gain significant market share. I was wrong. We misjudged the competition and priced the product too high. This was a significant error on our part, and here is what we are doing to fix it. A single, clear admission like this is worth more than 10 pages of self-congratulation. It tells you management is rational, not egotistical, and is focused on solving problems rather than hiding them. Third on our scorecard is the jargon jar. As you read the report, imagine you have a physical jar next to you. For every piece of meaningless corporate jargon you encounter, phrases like actioning our deliverables, creating a paradigm shift, deep diving into our verticals, or leveraging our ecosystem, you put a virtual dollar in the jar. The more dollars in the jar at the end, the lower the candor score. Great business leaders, like great writers, use simple, precise language. They aim to clarify, not to impress. A report filled with jargon is often a report with nothing important to say. Fourth is the owner test. This is perhaps the most crucial step. Read the entire letter as if you were not a small shareholder with 100 shares, but the sole owner of the business. Imagine you inherited this company from your parents, and you hired this CEO to run it for you. Is this person talking to you like a partner? Are they explaining the business's challenges and opportunities in the same way you would discuss them at your kitchen table? Or are they giving you a slick, polished sales presentation designed for a Wall Street analyst? Buffett always says he thinks of his shareholders as his partners. The letter should feel like a genuine, honest conversation between partners. If it feels like a marketing document, you are likely dealing with a promoter, not a partner. Finally, compare and contrast. This step requires a little more work, but it is invaluable. Pull up last year's annual report. Read the CEO's letter from 1 year ago. What promises did they make? What were the key initiatives they highlighted? Now, look at this year's report. Did those promises materialize? Is there any mention of last year's key initiatives? Or have they been quietly forgotten, replaced by a new set of buzzwords and grand plans? A trustworthy management team builds on a consistent strategy year after year. They report on their progress, both good and bad. A less reliable team hopes you have a short memory. They present a brand new, revolutionary plan every year, never acknowledging the failures of the past. The Candor Scorecard is not a perfect system, but it imposes a discipline. It forces you to move beyond a passive reading of the text and engage in an active interrogation of the author's intent, honesty, and clarity of thought. To truly appreciate the power of this approach, we must examine its opposite. We must walk the path of the 99%. The average investor, business person, or even executive does not engage in this kind of deep reading. They are operating in a world of information overload and have been conditioned to seek shortcuts. Their primary sources of information are financial news networks, sensational headlines from online publications, and the charismatic media-trained performances of CEOs in interviews. They have fallen victim to the narrative fallacy, and they actively outsource their critical thinking to others. They believe that if an analyst from a major bank has a buy rating on a stock, the due diligence has been done. They believe that if a CEO is confident and articulate on television, they must be a competent leader. This approach is not just suboptimal, it is catastrophically dangerous. Consider the case of a once hyped technology company, a company that promised to revolutionize an entire industry. Its CEO was a visionary, a master storyteller who captivated the media and the market. He spoke in grand terms of changing the world, of building a global brand. His interviews were masterclasses in charisma. Investors who followed this path were mesmerized. They bought the story, and they bought the stock, pushing its valuation to astronomical levels. But what if they had ignored the interviews and instead sat down to read the company's annual reports with our candor scorecard? They would have found a jargon jar overflowing with impenetrable phrases about leveraging technology to elevate consciousness. They would have found no specific admissions of mistakes, only grand pronouncements of successes and vague references to execution challenges. Applying the owner test, they would have felt they were being sold a utopian vision, not being briefed on the sober realities of a business. And a compare and contrast analysis would have shown a carousel of strategic initiatives, each one announced with great fanfare and then quietly abandoned a year later. The language in the reports was a direct confession of a lack of focus, a lack of discipline, and a dangerous detachment from reality. The path of the 99% is to be seduced by the story. The path of the disciplined reader is to dissect the language of the storyteller. The eventual collapse of such companies is never a surprise to those who chose the latter path. They saw the confession, written in plain sight, years before the market finally acknowledged it. The final critical question is how this principle of candor connects directly to the financial statements and the ultimate value of a business. This is not a soft skill. It is a hard financial metric. The connection is direct and powerful. First, candid management leads to better capital allocation. A management team that is unafraid to admit mistakes is a team that is unafraid to kill a failing project. They are not beholden to the sunk cost fallacy, where they continue to throw good money after bad to save face. An honest internal culture means that bad news travels up the chain of command quickly, allowing problems to be addressed when they are small. In a culture of obfuscation, bad news is hidden until it becomes a catastrophe. This rational approach to problem solving and capital allocation directly prevents massive write-offs and value destruction that plague companies run by egotistical leaders. Second, candor reduces what institutional investors call surprise risk. A candid company will tell you about emerging problems in the industry or specific operational challenges long before they become full-blown crises. They manage shareholder expectations responsibly. Companies that only ever report good news create a fragile environment where any negative event comes as a complete shock, often leading to a violent collapse in the stock price. The stock of a candid company tends to have lower volatility because the market is better informed. This lower risk profile makes the business fundamentally more valuable. In the world of wealth management and equity analysis, a lower risk stream of earnings is discounted at a lower rate, leading to a higher present value. An investor is willing to pay a candor premium for the stock of a company run by honest management. Finally, a culture of candor that starts in the annual report permeates the entire organization. It leads to higher employee morale and trust, which in turn reduces costly employee turnover. It builds stronger relationships with suppliers and customers. It creates a reputation that, as we saw with American Express, is itself a priceless competitive advantage. The chairman's letter is the tip of the iceberg. The language used in that letter is a reflection of the culture that lies beneath the surface. By analyzing that language with the rigor of a detective, we are not just evaluating a piece of writing. We are assessing the foundational integrity of the entire enterprise. And in the long run, integrity is the single greatest driver of financial value. Having established the critical importance of language, we now turn to the numbers. But not in the way most people do. We are not looking for last quarter's earnings per share. We are looking for something far more profound. The story of the company's decisions written in the language of money. This brings us to our second pillar, the map of capital, following the money's journey. To Buffett, a company's financial statements, particularly the statement of cash flows, are a map. They reveal where the money comes from and, more importantly, where the CEO chooses to send it. A CEO can talk all day about long-term value and shareholder focus, but the capital allocation decisions are the ultimate confession of their true priorities. Is the cash being reinvested back into the business to fuel growth? Is it being used to make smart acquisitions? Is it being returned to shareholders through dividends and buybacks, or is it being squandered on pet projects and empire building? Following the money is the most effective way to cut through the noise and understand the real strategy of the business. A masterclass in this form of analysis can be found in Buffett's long-term investment and admiration for the Washington Post Company, particularly under the leadership of Katharine Graham. When Buffett started buying stock in the Post in 1973, it wasn't just a newspaper company. It was a collection of assets, including Newsweek magazine, television stations, and other properties. Wall Street drastically undervalued it, viewing it through the narrow lens of a struggling newspaper industry. Buffett, however, read the company's annual reports not as a story about journalism but as the biography of a brilliant capital allocator, Katharine Graham. He would have spread out a decade's worth of reports and traced the flow of capital year after year. He would have seen the cash generated from the flagship newspaper, a business with a powerful local monopoly, a true economic moat. And then he would have meticulously tracked what Graham did with that cash. The financial statements would have been his map. The statement of cash flows, in the section Cash Flow from Investing Activities, would have shown him the story. He would see her selling off unprofitable assets, even when it was emotionally difficult. He would see her resisting the urge to make flashy, overpriced acquisitions, a temptation to which many of her media peers succumbed. In the Cash Flow from Financing Activities section, he would have seen a consistent and intelligent program of share buybacks. Graham was buying back the company's own stock at prices she knew were far below its intrinsic value. This was an act of profound financial intelligence and discipline. It was a direct transfer of value to the remaining shareholders, including Buffett. He wasn't just investing in a newspaper. He was investing in a CEO whose financial reports confessed a deep understanding of value and a commitment to rational decision-making. The numbers, year after year, proved that her words about creating long-term value were not just talk. Her actions, documented in the cold, hard figures of the financial statements, validated her narrative. This deep business analysis, focused on the CEO's actual decisions, allowed Buffett to see a phenomenal business where others saw an old media dinosaur. It was an investment in a person's judgment as much as in a company's assets, a judgment that was confessed year after year in the map of capital. The psychological principle underpinning this method is known in economics as revealed preference. This principle is simple yet profound. You can ignore what people say. Their true preferences are revealed only by what they do, especially what they do with their money. A CEO can deliver a passionate speech about the importance of innovation and research and development. But if you look at the annual report and see that the R&D budget has been slashed for 3 years in a row to meet short-term earnings targets, their revealed preference is for short-term profits, not long-term innovation. The capital budget is a confession of what management truly values. Buffett's analysis is a systematic application of the revealed preference principle to corporate management. He listens to the words, but he trusts the numbers. This approach is also the ultimate tool for diagnosing the agency problem. In corporate finance, the agency problem describes the inherent conflict of interest between a company's management, the agents, and its shareholders, the principals. Management might be incentivized to act in ways that benefit them personally, through higher salaries, bigger bonuses, more prestige, even if those actions are not in the best long-term interest of the owners. For example, a CEO might pursue a massive, risky acquisition because running a larger company, empire building, would increase their prestige and compensation, even if the acquisition destroys shareholder value. Analyzing capital allocation is the clearest way to detect the severity of the agency problem. Are decisions being made to rationally increase the per-share intrinsic value of the business, or are they being made to grow the empire for its own sake? A CEO who consistently buys back shares when they are cheap is signaling a clear alignment with shareholders. A CEO who consistently issues new shares to fund overpriced acquisitions is signaling that their interests may lie elsewhere. The map of capital doesn't just reveal the company's strategy, it reveals the CEO's character and alignment with the people they are supposed to serve. To apply this principle ourselves, we can use a mental model called the 4 fountains of capital. This is a blueprint for analyzing the statement of cash flows to understand a CEO's capital allocation skill. The process begins by identifying the source of the capital. Look at the top of the statement for net cash provided by operating activities. This is the lifeblood of the business, the cash generated from its core operations. Is this number consistently positive and growing? Is it high-quality cash, or is it propped up by accounting tricks like letting accounts receivable balloon? This is the reservoir from which the fountains flow. Once you have a sense of the cash being generated, you trace where it goes. There are only 4 main destinations, our 4 fountains. Fountain number 1 is reinvestment in the business, often called capital expenditures or CapEx. This is money spent on new factories, new technology, and maintaining existing assets. The key here is to distinguish between maintenance CapEx, the amount needed just to keep the business running as is, and growth CapEx, the amount being invested to expand. A great CEO will clearly explain this distinction in the annual report. The most important question for an investor is, what is the return on this invested capital? A company that can reinvest its earnings at a high rate of return is the holy grail of investing. Fountain number 2 is acquisitions, or M&A. This is where the company uses its cash to buy other businesses. This is often the most dangerous use of capital. Look in the footnotes for details on recent acquisitions. How much was paid? How much of that price was allocated to goodwill? Goodwill is an intangible asset that essentially represents the premium paid over the fair market value of the assets acquired. A large and growing goodwill account can be a sign of a company that habitually overpays for acquisitions, destroying shareholder value in the process. Look at the company's history. Have past acquisitions worked out, or were they quietly written off a few years later? Fountain number 3 is shareholder returns. This is cash returned directly to the owners of the business. It can take 2 forms: dividends or share buybacks. Dividends are straightforward cash payments. Share buybacks are when the company uses its cash to purchase its own stock on the open market, reducing the number of shares outstanding and increasing each remaining shareholder's stake in the business. The crucial question for buybacks is the price. A CEO who buys back shares when the stock is trading below its intrinsic value is creating immense value. A CEO who buys back shares when the stock is at an all-time high is often just trying to prop up the stock price and is destroying value. Fountain number 4 is paying down debt. A company can use its operating cash flow to reduce its liabilities, strengthening the balance sheet and reducing risk. This is often a very prudent and intelligent use of capital, especially for a company that has become over-leveraged. After tracing the flow of cash to these 4 fountains, you must act as a judge. Grade the CEO. Are they making rational, intelligent decisions? Are they starving a high-return division of capital while pouring money into a failing one? Are they buying back shares at intelligent prices? Are their acquisitions disciplined and strategic? The statement of cash flows isn't just an accounting document. It's a report card on the CEO's most important job, capital allocation. Now let's consider the antithesis, the path taken by the 99%. The average investor is obsessed with a single, often misleading metric, earnings per share, or EPS. They listen to the quarterly earnings calls, and if the company beats EPS estimates by a penny, they cheer. They rarely ask how that EPS number was generated. They don't realize that EPS can be easily manipulated in the short term, often at the expense of long-term value. A company can boost its EPS by slashing its R&D budget, cutting its marketing spend, or delaying necessary maintenance. These actions make the present look better by mortgaging the future. They can also boost EPS by making a large acquisition using their own overvalued stock as currency. This might increase earnings in the short run, but if they overpaid for the acquisition, they have permanently destroyed long-term value. A classic example is the serial acquirer, a company whose entire strategy is based on constantly buying other companies. In a bull market, they can use their own inflated stock to make these purchases. The accounting rules often allow them to report rosy-looking earnings, and the constant deal-making creates a sense of excitement and growth. The CEO is hailed as a genius. The 99%, focused only on the headline EPS growth, pile into the stock. But the disciplined analyst, using the Four Fountains model, would see the truth. They would see that the cash from operations is weak, that the acquisitions are being made at absurd prices with huge amounts of goodwill, and that the return on the total capital being invested is actually terrible. They would see a house of cards while everyone else sees a rocket ship. The focus on short-term EPS is a fatal flaw in the investment process of the masses. The focus on the long-term, rational allocation of cash is the secret of the masters. The direct financial connection between skilled capital allocation and shareholder wealth is the most powerful force in finance. It is the engine of compounding. Imagine two companies, Company A and Company B, both earn $1 billion in profit this year. The CEO of Company A, believing his job is to reward shareholders immediately, pays out the entire $1 billion as a dividend. The shareholders get a nice check. The CEO of Company B, a skilled capital allocator, retains the $1 billion and reinvests it into projects, new factories, new technology, smart acquisitions that generate a 20% return on that capital. Next year, Company B will have an extra $200 million in earnings power. Company A will be exactly the same size. If this process continues for a decade, Company B will be a financial juggernaut, its intrinsic value having compounded at a spectacular rate. Company A will have simply treaded water. The difference in their stock prices will be astronomical. The ability to assess this critical skill, the skill of capital allocation, is what separates true business analysis from simple speculation. The annual report, and specifically the statement of cash flows, is the only public document that provides the necessary evidence to make this assessment. It is the key to understanding how wealth management is practiced at the highest corporate levels, and it is the single most important determinant of long-term investment success. We've examined the language and the flow of money. Now we must go deeper to the very heart of the enterprise, its fundamental business model. This is our third pillar, the unit economics confessional, deconstructing the core business model. Buffett is famous for wanting to invest in businesses he can understand. This isn't because he's intellectually lazy. It's because he knows that sustainable success comes from a simple, powerful, and durable underlying economic engine. He uses the annual report to look past the quarterly noise and the grand strategic pronouncements to answer a few simple questions. How does this business actually make money? Is it a good business? What protects it from competition? The numbers in the financial statements, viewed over a multi-year period, confess the true nature of the business's economic reality. They reveal the presence or absence of what Buffett calls a durable competitive advantage, or a moat. The quintessential story illustrating this principle is Buffett's 1972 acquisition of See's Candies, a transaction that would forever shape his investment philosophy. On the surface, See's was an unremarkable family-owned chocolate company. It wasn't a high-growth technology company. It was a chain of old-fashioned candy shops. To most investors, it was boring. But when Buffett and his partner Charlie Munger looked at the financial reports, they saw a confession of a truly extraordinary business. The numbers told a story of incredible customer loyalty and pricing power. The reports would have shown consistently high profit margins. They would have revealed that the business required very little capital to operate. There were no massive factories to build or expensive research to fund. It was a simple business of buying ingredients, making chocolate, and selling it through small shops. But the most beautiful part of the confession was this. Every year, the company could raise its prices by a small amount, and customers would happily pay. The brand was so powerful in the minds of its customers on the West Coast, so associated with quality and nostalgia, that it was immune to price competition. This pricing power was the moat. It meant that See's could offset inflation and then some, generating an ever-increasing stream of cash for its owners. Buffett and Munger paid $25 million for See's. Since then, it has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, cash that has been used to fund countless other investments. See's Candies became the blueprint. It taught Buffett that it was better to buy a wonderful business at a fair price than a fair business at a wonderful price. The annual reports of this small chocolate company confessed a secret of immense value: the power of a simple, durable business model with a deep economic moat. It was a lesson in looking for quiet, cash-gushing quality over loud, cash-burning growth. The psychological principle at the heart of this approach is a disciplined application of Occam's razor, the idea that the simplest explanation is usually the right one. Buffett applies this to business models. A business that is fiendishly complex, with dozens of moving parts and a convoluted strategy, is often a business that is hiding fundamental weaknesses. Complexity can be a mask for a lack of a core competitive advantage. Buffett seeks businesses that are, at their core, simple and robust. This ties into the concept of cognitive ease. Our brains are naturally drawn to things that are easy to understand and process. However, Buffett's genius is in applying this principle with immense discipline. He doesn't just look for businesses that are easy to find or that have a simple story. He does the hard work of reading the reports to find businesses that are fundamentally simple in their economic function. He is searching for the elegant, durable machine, not the complex, fragile contraption that looks impressive but shatters under stress. He knows that a business with a simple, powerful economic engine, like selling a beloved chocolate that people will pay more for every year, is far more resilient and predictable than a complex conglomerate trying to be all things to all people. He actively resists the allure of complexity and seeks the profound power of simplicity. To put this principle into practice, we need a mental model, a checklist for identifying a great business model within the financial statements. Let's call it the moat analysis checklist. The first item is gross margin stability. The gross margin is calculated as revenue, cost of goods sold, / revenue. It tells you how much profit the company makes on each dollar of sales before accounting for overhead costs. Look at the gross margin over a 5 to 10 year period. In a great business with a strong moat, the gross margin will be high, often above 40%, and remarkably stable or even increasing over time. This is the clearest numerical evidence of pricing power. A company that must constantly compete on price will have low and volatile gross margins. The second and perhaps most important item on the checklist is a metric Buffett loves: return on tangible capital employed, ROTCE. This sounds complicated, but the concept is simple. It measures how much profit a business generates for each dollar of real physical capital invested in its operations. You can calculate it roughly as pre-tax earnings divided by total assets minus intangible assets minus current liabilities. A consistently high ROTCE, say above 25%, is the sign of a phenomenal business. It means the company is a capital-light compounder. It doesn't need to build massive, expensive factories to grow. See's Candies is a perfect example. It generates huge profits from a very small base of tangible assets. A business with a low ROTCE, like an airline or a steel mill, is a capital-heavy business that must constantly spend enormous sums just to stay in the game. Third is sales, general and administrative, SG&A leverage. SG&A includes costs like marketing, salaries for corporate staff, and office rent. In a great business with a scalable model, SG&A as a percentage of revenue should decrease as the company grows. This shows that the business has operating leverage. As it gets bigger, its overhead doesn't grow as fast as its sales, meaning more and more of each new dollar of revenue drops to the bottom line as profit. A company where SG&A grows in lockstep with revenue may not have a scalable model. Finally, you must use the numbers to deduce the customer's incentive. The annual report won't have a section titled Our Moat. You have to be a detective. The numbers are the clues. If the company has high gross margins and is the low-cost provider in its industry, like Geico or Costco, its moat is its scale and cost efficiency. If it has high margins and spends a huge amount on advertising, like Coca-Cola, its moat is its brand. If its value to each customer increases as more customers join the network, like American Express, its moat is a network effect. The numbers confess the asterisk's existence of the moat. Your job as an analyst is to use those clues to identify its source. To fully grasp this, we must again consider the antithesis, the path of the 99%. The average investor is not a moat detective, they are a growth chaser. They are mesmerized by top-line revenue growth above all else. They will eagerly buy the stock of a company whose revenues are growing at 50% per year, without ever stopping to analyze the unit economics of that growth. They are buying the story of growth, not the reality of the business model. Consider the cautionary tale of many disruptive tech companies, for example, a meal kit delivery service. In its early days, the revenue growth was breathtaking. The story was seductive. They were changing the way people eat. The 99% piled in, chasing the growth. But a disciplined analyst applying the moat analysis checklist would have uncovered a horrifying confession in the annual report. Gross margins were razor thin. They were selling a $20 box of food that cost them $18 in ingredients and shipping. The return on tangible capital was terrible, as they had to build expensive refrigerated warehouses all over the country. And worst of all, the SG&A analysis would have revealed a fatal flaw. The quote, customer acquisition cost buried in the marketing line item was enormous. They were spending, say, $100 in advertising to get a new customer. But the footnotes on customer churn would have shown that the average customer only stuck around for a few months, generating perhaps $80 in lifetime gross profit. They were spending $100 to make $80. This is not a business model, it is a cash incinerator. But because the top-line revenue was growing so fast from all this marketing spend, the market ignored the disastrous unit economics for years. The annual report confessed the truth, that the business had no moat, no pricing power, and a fundamentally broken economic engine. But only those who knew how to read the confession were saved from the inevitable collapse. The direct financial connection between a strong business model and long-term value is absolute. A business with a deep, wide moat possesses a financial resilience that is priceless. It can raise prices to offset inflation, protecting its profit margins. It can fight off new competitors without having to engage in ruinous price wars. Because it often requires less capital to grow, it generates more free cash flow, the cash left over after all expenses and investments, which can be used for intelligent capital allocation. This predictable, growing stream of free cash flow is the ultimate source of a company's intrinsic value. In the language of finance, a business with a strong moat has a lower risk profile and more predictable future earnings. This directly translates into a higher valuation multiple. The market, in the long run, recognizes and rewards the durable profitability that a great business model generates. The process of deconstructing the unit economics through the annual report is the core of fundamental analysis. It is how you move beyond speculating on a stock price and begin the process of smart investing in a wonderful business, laying the groundwork for true, sustainable financial freedom. We have now learned to interpret the language of leadership, the flow of capital, and the core economic engine. But some of the most important confessions are not in the main body of the report. They are hidden in plain sight, in the section that almost everyone ignores. This brings us to our fourth pillar, the footnote detective, uncovering hidden risks and realities. The footnotes to the financial statements are the dense, text-heavy pages at the back of the annual report. To most people, they are an unreadable wall of legalese and accounting jargon. But to Buffett and other sophisticated investors, the footnotes are where the bodies are buried. While the income statement and balance sheet tell you times what the company did, the footnotes tell you how times they did it. They reveal the assumptions, the judgments, and the accounting choices that underpin all the headline numbers. This is where corporate fiction is tested against financial fact. Learning to read the footnotes is like being a detective who has just been given access to the suspect's private diary. A powerful historical example of the importance of footnote detection was the dot-com bubble of the late 1990s. During this era of market mania, a new form of accounting became popular among technology companies: pro forma earnings. Companies would report their headline results using these pro forma numbers, which conveniently excluded certain non-recurring or non-cash expenses. The most significant of these excluded expenses was stock-based compensation. These tech companies were paying their employees not just with cash, but with massive grants of stock options. This was a very real expense. It diluted the ownership stake of existing shareholders and transferred immense wealth from them to the employees. But under the pro forma accounting gimmick, this enormous cost was simply ignored. Warren Buffett was a vocal and relentless critic of this practice. He saw it as a dishonest attempt to mislead investors. A person who simply looked at the press releases or the CEO's glowing letter would have seen a generation of brilliant companies reporting fantastic pro forma profits. They would have believed they were investing in the future of the economy. But the footnote detective, the disciplined reader who ventured into the back of the annual report, would have found a very different story. Buried in the footnotes, there would be a section on stock-based compensation. And there would be a legally required reconciliation showing the company's earnings under generally accepted accounting principles, or GAAP. This reconciliation was the confession. It would show that these profitable companies were, in fact, losing catastrophic amounts of money. The pro forma profit of $50 million would become a GAAP loss of $200 million once the very real cost of stock compensation was included. The footnotes confessed that the entire business model was a sham, propped up by deceptive accounting. For those who read them, it was the clearest possible signal to avoid the bubble and the devastating crash that followed. The footnotes were the difference between financial salvation and financial ruin. The psychological principle that makes footnote analysis so crucial is called inattentional blindness. This is a fascinating cognitive bias, famously demonstrated in an experiment where people were asked to watch a video of a basketball game and count the number of passes. During the video, a person in a gorilla suit walks into the middle of the game, beats their chest, and walks off. A startlingly high percentage of people, because their attention is focused so intently on counting the passes, do not see the gorilla at all. It is right there in plain sight, but they are blind to it. The same is true of annual reports. Companies and the financial media direct investors' attention to the big, bold numbers: revenue, net income, earnings per share. These are the passes we are told to count. Our attention is so focused there that we become blind to the gorilla hidden in the dense text of the footnotes. Buffett's method is a conscious and deliberate effort to overcome this bias. He knows the most important information is often found where no one else is looking. He actively directs his attention to the boring, complicated parts of the report because that is where the truth resides. Companies sometimes exploit this bias, using what could be called complexity camouflage. They intentionally make the footnotes as dense and difficult to read as possible, knowing that this will discourage all but the most diligent readers from scrutinizing them. The footnote detective's job is to pierce this camouflage. To become a footnote detective, you need a systematic approach, a mental model for navigating this dense terrain. Let's call it the financial landmine detector. It's a checklist of key areas to investigate in the footnotes. First, and most importantly, is the very first footnote, which is almost always titled Significant Accounting Policies. This is the Rosetta Stone for the entire financial report. It tells you how the company makes its key accounting judgments. How do they recognize revenue? Do they book a sale when they ship the product, when the customer receives it, or only after the customer has paid? A company using aggressive revenue recognition policies is a major red flag. Has the company changed any of its accounting policies recently? A sudden change is often a sign that the company is trying to mask deteriorating performance. Second, search for the footnote on debt. This will detail all the company's loans and bonds. Look specifically for information on debt covenants. These are rules imposed by the lenders that the company must follow. For example, a covenant might state that the company's debt-to-equity ratio cannot exceed a certain level, or that its operating income must remain above a certain threshold. If the company violates a covenant, the lender can demand immediate repayment of the entire loan, which can easily force a company into bankruptcy. These covenants are hidden financial time bombs, and the footnotes are the only place to find them. Third, look for any mention of off-balance sheet liabilities. This is where companies can hide obligations that don't appear on their main financial statements. Enron was the master of this, using complex entities called special-purpose vehicles to hide billions of dollars in debt. Look for footnotes on operating leases, contingent liabilities, or guarantees. These can represent massive future claims on the company's cash flow that are invisible to the casual observer. Fourth, if the company has a large traditional pension plan for its employees, investigate the footnote on pensions. Companies have to make an assumption about the future rate of return their pension plan assets will earn. If they use an unrealistically high assumption, say they assume the assets will earn 9% per year forever, they can artificially reduce their reported pension expense and thus boost their current earnings. This is a common trick for flattering the numbers in the short term, but it can lead to massive pension shortfalls down the road. Finally, always read the footnote on legal proceedings or litigation. This section will disclose any major lawsuits the company is facing. Are they being sued by a competitor for patent infringement? Are they facing a massive class action lawsuit from customers? This footnote can alert you to a potential future liability that could cripple the company financially. Reading the footnotes is not easy. It requires patience and focus. But it is the single most important act of due diligence an investor can perform. The antithesis path, taken by the 99%, is to treat the footnotes like the terms and conditions on a software update. They scroll right past them. They accept the headline numbers, revenue, net income, EPS, as if they were gospel truth carved in stone. They don't understand that these numbers are the end result of a long series of assumptions, estimates, and accounting choices. They outsource their trust to the company's auditors, assuming that an auditor's sign-off means everything is fine. They fail to understand that an audit simply confirms that the company followed the rules of accounting. It doesn't confirm that the business is healthy, or that the accounting choices made were conservative and honest. The result of this willful ignorance is catastrophic surprise. The financial crisis of 2008 is the ultimate example. Many of the major financial institutions that collapsed or required massive bailouts looked perfectly healthy based on their headline numbers. Their reported profits were strong, and their balance sheets seemed robust, but the footnotes to their annual reports told a story of terrifying risk. The footnotes on their exposure to subprime mortgages, on the valuation of their complex derivative securities, and on the nature of their massive off-balance sheet vehicles would have been a 5-alarm fire for any diligent footnote detective. The confessions were there, the risks were disclosed, albeit in dense, technical language. The 99% who ignored the footnotes were shocked and horrified when these institutions suddenly imploded. The 1% who did the hard work of reading them were not surprised at all. They had read the confession and understood the danger long before the crisis hit. The direct financial connection here is profound. The footnotes allow an investor to determine the asterisk quality of a company's reported earnings. Two companies can both report $1 billion in net income. Company A's earnings are clean, backed by cash, and based on conservative accounting. Company B's billion-dollar profit is propped up by aggressive revenue recognition, changing its accounting policies, and using an unrealistically high pension return assumption. A disciplined financial analyst knows that Company A's earnings are real and sustainable, while Company B's are a fragile illusion. Therefore, Company A is fundamentally worth far more than Company B, perhaps twice as much. By uncovering the secrets in the footnotes, you can adjust a company's reported numbers to better reflect its true economic reality. This process of deep due diligence is the heart of professional business intelligence. It protects you from catastrophic losses and allows you to calculate a true margin of safety for your investments. It is the crucial, final step in separating financial fact from corporate fiction. We have now assembled the core tools of our analytical arsenal. We know how to judge management's character through their language. We know how to track their true priorities by following the money. We can deconstruct the core business model to find a competitive moat. And we can dig through the footnotes to uncover hidden risks. The final step is to bring all of these elements together, not just in a single moment in time, but over the grand sweep of a business's life. This brings us to our fifth and final pillar, the consistency test, the narrative versus the numbers over time. Buffett's true genius is not just in analyzing a single annual report. It's in his ability to read a decade of them and see the long, unfolding story of a business. He is not looking for a snapshot. He is watching the movie. The ultimate test of great management and a great business is consistency. Does the CEO's narrative from year 1 match the financial results in year 10? Does the company's competitive advantage deepen over time, or does it erode? This longitudinal analysis, this comparison of promises made to promises kept, is what separates a truly great enterprise from a flash in the pan. It is the final and most powerful confession of all. The greatest foundational anecdote for this principle is the story of Berkshire Hathaway itself. The ultimate test of Buffett's entire philosophy is to apply it to his own company. Imagine going back and reading Buffett's shareholder letters from the 1970s, the 1980s, and the 1990s. In those early letters, you would find the DNA of his entire system. You would read his clear, candid prose, explaining complex business concepts in simple terms. You would find his unwavering commitment to treating his shareholders as partners. You would read his explicit promises to be a rational capital allocator, to invest only in businesses with durable moats that he could understand, and to buy them at sensible prices. The narrative was established early and with perfect clarity. Then, your task would be to watch the movie. You would read each subsequent annual report, not just for the letter, but for the numbers. You would see the capital generated by the early textile business being rationally reallocated into superior businesses like See's Candies and the Washington Post. You would see the acquisition of Geico, a low-cost provider with a massive moat. You would track the purchases of Coca-Cola and American Express stock, classic examples of wonderful businesses bought at fair prices. The financial statements, year after year, decade after decade, provided the quantitative proof that validated the qualitative narrative. The promises made in the early letters were being demonstrably kept. The numbers and the narrative told the exact same story. He said he would treat shareholders like partners, and the reports confirmed his famously modest salary and the lack of executive perks common elsewhere. He said he would not dilute their ownership, and the reports showed a share count that barely changed for decades. Reading the collected annual reports of Berkshire Hathaway is the ultimate masterclass in the consistency test. It is the story of a clear, powerful narrative being relentlessly and successfully executed over a 50-year period, resulting in the greatest wealth creation engine in modern history. The underlying psychological principle at play here is the power of a narrative data feedback loop. A great leader, in any field, first creates a compelling and coherent narrative, a vision, a strategy, a set of principles. They then execute on that narrative in a way that generates hard data, financial results, key performance indicators, that reinforces and validates the original story. This creates a virtuous cycle, a positive feedback loop. The strong narrative guides the actions. The successful actions generate validating data, and the validating data strengthens the credibility of the narrative, which in turn inspires more successful action. Trust is built and compounded over time. Conversely, a weak or ineffective leader often has a narrative that is constantly contradicted by the data. They promise growth, but the numbers show stagnation. They promise innovation, but the R&D budget is cut. This creates a narrative data dissonance, a negative feedback loop that erodes credibility and destroys trust. Humans are natural pattern recognition machines. Buffett's genius is to apply this instinct with discipline. He demands that the pattern of success exist not just in the qualitative story told by the CEO, but also in the cold, hard, quantitative results reported over a long period of time. To apply this powerful principle, we need a final mental model, the decade-long due diligence. This is not a quick analysis, it is a deep, immersive study of a business. The first step is to gather the archives. Go to a company's investor relations website or the SEC's public database and download the last 10 annual reports. Step 2 is to anchor on the first letter. Go back to the report from 10 years ago. Read the CEO's letter carefully. From that letter, identify the 2 or 3 most important strategic priorities that management laid out. They might have been, our top priority is to expand into the Asian market, or we will focus on paying down our debt to strengthen our balance sheet, or we are committed to being the industry leader in research and development. Write these promises down. Step 3 is to trace the narrative thread. Now read the CEO letter from each of the subsequent 9 years. Is there a consistent story being told? Do they refer back to those original goals and report on their progress? Or does the strategy seem to change every single year, with a new set of buzzwords and a new revolutionary plan announced each spring? Look for consistency of purpose. Step 4 is to audit the numbers. This is where you hold the narrative accountable to reality. Go to the financial statements for that 10-year period. If they promise to expand into Asia, go to the geographic segment data in the footnotes. What percentage of revenue came from Asia 10 years ago, and what percentage comes from there today? If they promise to pay down debt, create a simple chart of their debt-to-equity ratio over the decade. Did it go down? If they promise to be an R&D leader, what was their R&D spending as a percentage of revenue each year? Did it increase and lead to successful new products? You are using the financial data as an independent auditor to verify the CEO's claims. The final step is to render your verdict. After this decade-long review, ask yourself one question. Does the story told by the numbers align with the story told by the CEO? A yes is the hallmark of competent, trustworthy, and aligned management. It is a powerful signal that this is an enterprise built for the long term. A no, a finding of narrative data dissonance, is one of the most significant red flags in the world of investing. It suggests a management team that is either incompetent, dishonest, or both. The path of the 99% is, once again, the complete opposite. The average investor is a prisoner of the present moment. They suffer from an extreme form of recency bias, the tendency to give excessive weight to the most recent information. They look only at the last quarter's earnings report, or, at best, the most recent annual report. They get excited by a new CEO who comes in and announces a bold new turnaround plan. They buy the stock based on this new story, without ever doing the historical research to see that the last 3 CEOs announced almost identical turnaround plans, all of which failed. A tragic example is a once great legacy retailer like Sears. For decades, a succession of new CEOs would arrive and pen an annual letter filled with hope and a bold new strategy. They would reimagine retail, leverage our real estate, build an integrated online experience. Each new narrative was compelling in the moment. The 99%, suffering from recency bias, would buy into the hope. But anyone who performed the decade-long due diligence would have seen a brutal, unassailable truth. The narrative changed every few years, but the numbers told only one consistent story: a relentless, catastrophic decline in revenues, in profits, in every single meaningful financial metric. The 10-year movie was not a story of turnaround attempts. It was a story of a slow, inevitable death. The dissonance between the hopeful annual narrative and the grim 10-year data was a screaming signal to stay away. The direct financial connection of the consistency test is the ultimate prize for an investor. Consistency is a proxy for predictability. A business with a management team that has a proven, decade-long track record of making rational promises and then keeping them is a fundamentally less risky enterprise. The financial markets reward predictability. A predictable stream of future earnings is valued more highly. It is assigned a higher multiple and a lower discount rate than an unpredictable one. Investing in these consistent, predictable businesses is how one builds true, lasting wealth and achieves genuine financial freedom. It is the opposite of gambling on short-term fads or turnaround stories. It is about partnering with proven, world-class operators whose actions, over a long period, have validated their words. This comprehensive, longitudinal method of fundamental analysis, which integrates the study of language, capital allocation, business models, and footnotes over an entire economic cycle, is the final expression of the Buffett methodology. It is the ability to not just read an annual report, but to understand the soul of the company it represents. You have just completed a deep immersion into a powerful system of thought. You've moved beyond the noise of the market and learned to listen to the confessions hidden in plain sight. You now possess a mental toolkit that allows you to assess the candor of a leader, to trace the real priorities written in the map of capital, to deconstruct the core economic engine of a business, to uncover the risks buried in the fine print, and to judge the ultimate test of consistency over time. This is not just a method for stock analysis. It is a framework for critical thinking that can be applied to any business decision, any investment, any entrepreneurial venture. You have acquired a significant advantage. But it is crucial to understand that Warren Buffett's system is not just a collection of independent tools. It is a network, an interconnected web of mental models that support and reinforce one another. The model you have just mastered, the deep reading of an annual report, is a foundational piece of that network. It is a critical hub, but it is not the entire map. To truly operate at the level of the greatest financial minds, you must understand how this piece connects to the others. How does the information gleaned from the report inform the calculation of a company's intrinsic value? How does it connect to the psychological discipline required to act when others are fearful? The journey to building a complete mental arsenal is a process of linking these powerful ideas together. The video that is now appearing on your screen is not a random recommendation. It is the next piece of that map. It is the link that connects the deep business analysis you have just learned to the next critical discipline in the system. Think of it as the bridge from understanding the company to valuing the company. The choice to click is not about watching another video. It is a decision to continue your ascent. It is a statement about the kind of investor, the kind of executive, the kind of decision-maker you intend to become. The truly serious student never stops at the first lesson. They seek to complete the entire architecture of knowledge. The next link in that chain is right in front of you. Complete your arsenal. Make the click.